Welcome to Money Mondays with Melissa, where we talk about financial empowerment while exploring financial assistance available through local, state, and federal governments, each month with a diverse group of subject matter experts. Chicago, are you ready to get financially empowered? Well, we've got just what you need. Without further ado, give it up for your Chicago City Treasurer, Melissa Conyears-Ervin.
Well, hello everybody. That was really an exciting intro video. Wow, I was not quite prepared for that. Anyways, so my name is Josh Cravan. I am the director of the Low Income Taxpayer Clinic at LadderUp. And today I'm going to talk a little bit about the basics of how individual tax works, and specifically how individual income tax works with both the federal government and the state government. Taxes can be stressful. They're often stressful because we don't understand how they work mechanically. They're a little more complicated than they could be in this country, and they're not super intuitive either. So what I'm going to try to do today is give you a sense of, at a very basic level, how they work, just so that you can approach them with more confidence and handle your obligations as accurately and smoothly as possible, so you don't have to think about taxes more than is necessary throughout the year. But first, just a little overview of what LadderUp does, our free services. We have three main arms of our organization. The first is called our Tax Assistance Program, or TAP, and that's kind of our bread and butter. This is how we serve and reach the most folks. And what we do through TAP is free tax preparation. So we prepare tax returns for folks at tax sites across the city, for folks who are beneath our income guidelines. Those income guidelines for individuals is $35,000. So if you're only filing for yourself, so you don't have a spouse that you're filing jointly with, you also don't have any dependents that you are claiming on your tax return. If that is the case, you can come on down and get your taxes done if your income is less than $35,000 for 2024. So if you made less than $35,000 between January and December of 2024. If you are filing for a family, so if you are filing jointly with your spouse, or if you are claiming dependents, the income guideline is $67,000. But what I'll say to that too, between you and me, the guidelines are somewhat soft, especially if it's a slower day at the tax site and you're close to that limit. If you're not exactly sure whether you're going to come in below or above that limit, come on in and we'll likely be able to serve you, even if you are, just a little bit over those guidelines. So don't let that stop you from coming to a tax site. Like I was saying, I am the director of the Tax Clinic, and the Tax Clinic represents folks who are in controversies with the IRS or the Illinois Department of Revenue, or IDOR. So this goes a little bit beyond, simple tax preparation. And this kind of falls into two buckets in my mind. One of those buckets is if you dispute the amount that you owe with the IRS. So maybe you filed your tax return claiming certain credits, certain income, certain deductions, and the IRS has proposed to change that tax return, to change what your refund is or what you owe, and you don't agree with that. The scary word for this is audit, but again, I know that can scare folks. But if you are getting an audit, we can help with that. We can represent you and give guidance as to whether the IRS is right, whether you might want to continue to contest the liability. We can represent you in that. Or maybe, the amount that you owe is not in dispute. Maybe the amount that you owe is simply more than you can afford to pay right now without experiencing financial hardship. If that's the case, the Tax Clinic can also help you. We can explore collection alternatives did the presentation? Okay, great. So if you owe more than you can afford to pay, the Tax Clinic can also help you explore collection alternatives like payment plans, or alternatively, we do what's called an offer and compromise, which is basically negotiating a settlement with the IRS for a lot less than what you owe based on your financial circumstances. So that's a little overview of what the Tax Clinic does. And we also have our Financial Capabilities Program, and that breaks down into the College Success Track, which is financial guidance for folks who may or may not be of traditional college age, but who are gearing up to pursue higher education. So we can go and talk about, how to complete the FAFSA, how financial aid works, how to budget during college. Or then we also have our adult literacy track, which more broadly is geared toward helping adults of all ages, in all financial circumstances, build financial stability through budgeting, through getting your credit score up, and just general, financial literacy tools and workshops. So that's kind of an overview of what LadderUp does from 20,000 feet. Like I said, right now we are doing, through our tax assistance program, free tax preparation. We went over the income limitations. And right now our priority is to prepare 2 years. We prepare 2024 tax returns because that is the current tax year, the year that is due on April 15th on tax day. And we also are focusing on preparing 2021 tax returns. And you might ask, why are we preparing 2021 returns? Those were due a long time ago. That's an older year. And the reason for that is that there is a deadline to claim a refund that is set by the IRS. And that deadline is generally 3 years after the tax return you're getting the refund on was due. So your 2021 return, that was due for most folks in April of 2022. And the 3-year deadline from that is April 2025. So we really want to help folks file these 2021 returns and get the money, the refund that they are entitled to before that due date, that deadline passes and it's no longer available. That's especially important with 2021 because 2021 was the year in which the last economic impact payment or stimulus payment was sent to folks. And so it's not too late to, on your 2021 tax return, if you did not get that stimulus payment, you can claim what's called the recovery rebate credit and have that $1,400 issued to you as a tax refund. So it's very important to get your taxes in for 2024 on time and also try to claim that 2021 refund before the deadline passes. If you need help with different years, we would advise you to go to our summer sessions, and those are usually every other Wednesday from June through about August at the Harold Washington Library. We'll have more information on those on our website once those dates are finalized. But at our summer sessions, we can do past tax years. We can do more complicated amendments of past tax returns if you need help with that. But that's what summer sessions are for. And then we can go to the next slide here. It'll show just kind of a map of all of our tax sites around Chicagoland. We have lots of them in the city of Chicago. We also have a few out in the suburbs like Aurora, Plainfield, that are a little more far-flung. So you can find out whichever one is most convenient for you. And then you can go to our website, goladderup.org/locations, and that will list, the addresses and also the days and times when each tax site is available. Every tax site tends to be open on Saturday mornings, and some sites have weekday availability as well, particularly our Uptown tax site at Truman College and also our tax site in the Loop at Harold Washington Library, like I was mentioning. Those are open throughout the week, but there are also select days at other sites too. So I would encourage you to just go on this website and find the one that is most convenient for you and is open at a convenient time for you. Okay, so let's start by zooming way out and just ask, what are taxes? They're a payment, as you might know, that is collected by the government. And you might ask, why does the government need my money? Well, the government needs your money because the government provides services to all of us. They, build roads and bridges and keep those maintained. They provide healthcare and subsidize healthcare to a lot of folks in this country. They also maintain the military, for better or for worse. And all of those things cost a lot of money and benefit us all as people in America, as Americans. And so we pay in taxes to fund those programs, to pay for the benefits that we're getting out. And these can be paid to the federal government, that's administered by the IRS, the state government, state of Illinois, that's the Illinois Department of Revenue, or even local governments such as Cook County. Cook County administers property taxes, amongst other things. So if you get a property tax bill, that'll likely be coming from Cook County, our local government. So it happens at all 3 levels to fund services that come from all 3 levels. Okay, so let's break it down into different types of taxes on individuals that you might encounter. The one we're going to talk about most today is income tax, and that might be owed on any economic benefit you receive. And that's just a fancy way of saying any income that you have throughout the year. And we'll break down types of income in just a second. There's also a special capital gains rate that might apply to income you make from investments. So if you have an investment, you hold it for a year or more, and then you make money by selling the investment, you turn a profit, that might have a special capital gains rate. That's what that's called. We also have something called payroll tax or self-employment tax. And this is a tax on earned income that you pay in to fund your Social Security and your Medicare benefits. So you pay this money in so that once you reach retirement age, you can collect Social Security checks, and you can also get Medicare. So you can also get subsidized healthcare when you're older and really need it. This looks different for employees versus independent contractors. We'll get into that a little bit later, but that's something to know. It's called payroll tax if you're an employee. It's called self-employment tax if you're an independent contractor. But any kind of worker, anyone earning income has to pay this tax to fund those benefits. There's also property tax. That's kind of what it sounds like. It's tax owed on land and buildings that you own, including your home, your primary residence. It's usually based on the value of the property. And like I said, it's typically paid to local governments, such as Cook County, to fund local programs. Sales tax, this is one you're probably familiar with. It's a tax on goods and services that you purchase, and it's paid by the customer at the time of purchase. So you are paying this, and you can see it on your receipt. It'll usually be separately listed as that tax that you pay on things you buy to the state government. So Illinois has its own state sales tax rate. Indiana has its own state sales tax rate. This is collected by states. There's also something called an excise tax. This one we don't really engage with very much because it's actually paid by someone who is selling you the goods as opposed to you paying it as the buyer of the goods. And it's usually built into the cost. So it doesn't have salience, as we would say. You don't see it. And that's only on certain types of goods like fuel, airfare, tobacco, and other items that the government thinks should be specially taxed with this excise tax. All right, so when you do file your individual income tax return, you do it on something called Form 1040. Why is it called Form 1040? I don't really know. It's a little bit random. I think that, maybe when they released this form, 1039 was the last one, maybe. I'm not sure. But anyways, it has all of these lines where you will list, the relevant numbers, like how much income you got, how much you're deducting, what you're going to owe in tax. It can be very overwhelming at first. There's a lot of numbers, a lot of lines, a lot of information you have to enter. But, most of it will actually be left blank for most people. And we're going to break it down so it's a lot less scary. And so we can actually understand what is going on so that the number that we come to at the end makes sense. And we understand why that number is accurate and fair. But like I said, we have this Form 1040. That's going to be the front 2 pages of your return. And then you'll also attach things called schedules and attachments that kind of show your work and go into more detail on the numbers that you ultimately put in on the front of this Form 1040. But let's break it down. Okay, so this is our roadmap here, our roadmap kind of going over the math that goes into determining what you're going to owe the government, whether you're going to get a refund, whether you have to send in money at the end of the year. And the first element of this is your gross income. That is all of the economic benefits you receive, all the money that is coming in throughout the tax year to you that the government might be interested in taxing. So let's break it down a little bit more as to what income might look like, what kinds of income the government might tax, what kinds of income the government might not tax. All right. So one distinction here to make first is the difference between earned income and unearned income. Because like I said, earned income crucially is taxed for purposes not only of income tax, but also for that self-employment or payroll tax that funds Social Security and Medicare benefits. Those benefits are based on how much earned income you have throughout your lifetime and how much payroll tax you pay in as a result of that earned income throughout your lifetime. So earned income is income where you are actively involved in the work that results in the money. So it might be compensation for services that you provide to someone, or if you're selling goods. So for example, maybe you work at a restaurant, you're compensated for the work you do at the restaurant, Or maybe you're in the business of selling restaurant equipment. So you make money by turning a profit on selling pots and pans and ovens and all that good stuff. Either way, in either of those cases, you are actively putting in work to get the money, and so that is earned income. Unearned income, on the other hand, is money that you earn without active involvement. So we can also call this passive income. An example of unearned income might be, interest from a bank account, because, once I put the money into the bank account, I'm doing something there. But at that point, the bank takes over. I don't have to do anything. It'll get interest, and that money is coming to me without any further action. Similarly, with Social Security benefits, even though I work throughout my life to become entitled to those, once I put in that work and once I qualify for Social Security, I don't have to do anything each month for those checks to keep coming to me. It's passively coming to me. It's unearned income, and so that'll affect how it's treated on our tax return. Something to note, though, is that both types of income might be taxable. Either type of income might count for income tax purposes. And so we'll break that down now in more detail, what the government might be interested in for income tax, what the government's not interested in for income tax. But again, the key takeaway here, I think, with earned income is that that is the kind of income that is taxed for payroll tax, for Social Security and Medicare. Okay. But let's look at examples of income here. So income that is considered income for income tax purposes that the government might want to take a little cut of. Wages and tips, like I was saying, that's classic earned income. Business income, so if you operate an LLC and make money that way, that would also count as income. Self-employment income, so if you are an independent contractor doing gig work, like rideshare work, food delivery work, that's also considered income. Rental income or royalty income. So if you rent out your home or a room in your home and get money for that, that's considered income. Certain Social Security payments, usually Social Security is not taxed for income tax purposes, but if you are above a certain threshold, it might be. So it's good to be aware of that. Social Security might result in tax and a filing requirement, and also certain retirement distributions. Retirement distributions are not taxed by the state of Illinois. That's a good thing to keep in mind, but they might be taxed for purposes of federal income tax. So you'll have to report what you get out of your 401k or your IRA. If you make those withdrawals during the year, you'll get a form and you'll need to report that. Certain things, though, are not considered income, even though you're getting a benefit, even though you're getting money from these things, getting value from these things. The government does not tax them, and so you don't need to worry about them when you're filling out your tax return. This includes any gifts of money or other assets. So if it's your birthday or your friends are just feeling generous and want to help you out, send you some cash or money, that's great. You don't have to worry about that for income tax. Life insurance proceeds are never taxed. Alimony is never taxed so long as the alimony agreement, the separation agreement, was entered into after 2018. And also child support payments are never considered taxable income because those are for the benefit of the child rather than the benefit of the taxpayer who is receiving that money and using it to support their child. Okay, so we've talked a little bit about what income is, what sort of economic benefits the government might want to tax. But before we actually calculate the tax, before we determine, how much of that is actually going to be applied into your tax brackets, we get to make some adjustments. We get to, in other words, adjust your income down. You get to take some of that income off before you get taxed, so this will result in you owing less tax. So let's look at what those adjustments might look like. So like I said, an adjustment allows you to reduce your gross income before your tax rate is applied. That's why AGI, you might hear the term AGI a lot. That stands for adjusted gross income. So that's a number that comes into play after these adjustments are accounted for. Some examples include student loan interest deduction. So if you went to school and took out loans for that and then paid some back, any loans that you pay back during the year, the interest portion of that can be deducted from your income and reduce your income. Some retirement contributions. So if during the year you paid into a traditional or pre-tax IRA or 401k, the money that goes into that can be deducted as well. That will not be taxed now. It'll actually be taxed because of the deduction. When you take it out, the income tax will be applied, much later in life, ideally. Capital losses can be an adjustment. So like I was saying, you might have a capital gain if you buy an investment, buy a stock, sell it later for more money. But if you buy a stock and then sell it later for less money, if say the market is bad, if the stock doesn't do well, you can take a capital loss on that and adjust down your income. Educator expenses. So if you're a teacher and you spend money on classroom supplies out of pocket, that can be taken out of your income. And then any HSA contributions. So if you have a health savings account and put money into that during the year to later be spent on qualified medical expenses, that money that you put in will also be deducted from your income and not be taxed. It'll reduce your taxable income. Something to note, though, is all of these, I describe them very generally, but each of them have different sorts of rules surrounding them that you'll have to make sure that you satisfy in order to actually take these accurately. Okay, so we've taken our gross income. We've thought about all of the money we received during the year. We determined, what of that money the government might want to tax that we have to report. But then we took some adjustments out of that income, like, student loan interest, like educator expenses, and that took our income down a little bit. But there's one more thing we get to do before the tax is calculated, and that's we get to take either the standard deduction or the itemized deduction on top of our adjustments. So let's look at that. Okay, so every return, like I said, will take a deduction, either the standard deduction or that itemized deduction. And the key thing to know here is that the tax rate on your income up to the deduction is 0%, meaning that any amount that is captured by this deduction will not be taxed at all. It's tax-free. The standard deduction is the first option, and this is the one that most folks these days will take. It's a deduction that is the same amount for everyone, as long as you have the same filing status and age as someone else, and we'll talk about filing status in a sec. But what's nice about the standard deduction is it's automatic for everyone. You don't have to prove anything. You don't have to actually have expenses to deduct. It's just automatic, the same amount for everyone. And as of 2018, the amount of the standard deduction was raised pretty significantly. And so for most people now, that standard deduction amount is more than what you can do by itemizing. And so most people do that standard deduction. So what are itemized deductions? Those are different deductions you can add up instead of the standard deduction. But the thing about these itemized deductions is that you have to actually prove that you spent money on something. You have to actually prove that you incurred the particular kinds of expenses that can be claimed for these itemized deductions. And key examples of itemized deductions include donations. So if you donated money to a charity, you can claim that. Any taxes that you paid to state and local entities, so state income tax, property tax, potentially even state sales tax, you can take that off. If you paid interest on a mortgage for your home, you can take that out. Also, if you had any really large medical and dental expenses, you can itemize those and deduct those. But the big picture here is you want to add up all your itemized deductions, compare that amount to the standard deduction for your filing status, and ask yourself, okay, which of those is greater? Which one of those gives me the bigger deduction that will take more out of my taxes? And again, for most people, for most low and moderate income earners especially, that is going to be the standard deduction. Okay, so let's talk about filing statuses. And this is, like I was saying, what determines the amount of that standard deduction you can take out of your taxes automatically. So single is kind of the base filing status. That is if you are unmarried and you have no qualifying dependents who live with you and who financially depend on you, then you would be single. But let's say you're unmarried, but you do have a dependent, a qualifying person who lives with you and financially depends on you, who you can claim as a dependent. In that case, you would be head of household, which is more advantageous because it provides you a larger standard deduction than filing as single to recognize, the expense that you incur as someone who is supporting the dependent in your home. If you are legally married and you agree to file together with your spouse on the same tax return, then you are married filing jointly. Something to know about this is that your marriage status, if you're wondering, okay, was I married in this year? Was I unmarried? It's about whether you were legally married on the last day of the tax year. So right now, if you're filing for 2024, the question you need to ask is, was I legally married as of December 31st, 2024? And that will determine your filing status. If you do file together, the tax brackets tend to be more advantageous than if you filed separately. But something to know is that you will both be liable. Both spouses on the return will be liable for the tax on that joint return. On the other hand, you can do married filing separately if you are legally married but want to keep your tax liabilities separate. In this case, spouse one will only owe the tax that they incurred. Spouse two will only owe the tax that they racked up during the year. But like I said, there are some credits that are harder to claim if you file separately. And also the tax brackets will work out not quite as well for you if you file separately. So we usually encourage folks to file jointly if they can and if they're legally married. There's also qualified surviving spouse. And this is for folks who are married and whose spouses pass away during a certain tax year. During that tax year in which they pass away, you'll be able to do married filing jointly. But even the year after that, if you do not remarry and if you have a dependent child in the household with you, you can file married filing jointly for the next 2 years after that, even despite the fact that you are now, technically unmarried. Okay, so we've talked about the income that you have. We've broken that down into what is taxed, what is not. We've made certain adjustments to reduce that income. We took the standard deduction or itemized deductions to reduce it farther. And now it is finally time to apply the tax brackets. We have finally arrived at our taxable income after those steps that we've been through so far. So let's look at how, once we've calculated our taxable income, how does our tax liability actually get calculated and shake out based on that? Okay, so a concept here that's important to understand is a progressive tax versus a flat tax. A flat tax means that the tax rate is the same regardless of how much money is being taxed. So for Illinois state income tax, for example, that is a flat rate of 4.95%. So whether you made $10 million that's going to be taxed by the state of Illinois, or you made $10,000 that's going to be taxed by the state of Illinois, the rate is 4.95%. The federal income tax system, on the other hand, is a progressive tax system. And that means that as your income progresses upwards, so does the tax rate. So as your income increases, so does the amount of tax, the percentage of tax taken out of that additional income. And that's so that people who have more ability to pay, who have, who more income throughout the year, pay their fair share and, pay into the systems to fund the system for all of us. Okay, so an important implication of this is, if someone says their tax bracket is 22%, it does not mean that all of their income is taxed at 22%. It just means that, the highest tax rate that will be applied to some of their income is 22%. They metaphorically made it to the 22% step on the progressive income tax staircase. So what this means is that, moving into a higher tax bracket is never a bad thing because it doesn't change the taxes that have already been applied to, your lower income. It just increases the rate on the additional higher income that you make. But even then, the highest rate that we have that's shown here is 24%, which means that, most of that additional higher income you will still keep and it's still going to go into your pocket. So don't be afraid of moving up a tax bracket. That just means that, you made more income throughout the year, which is a good thing. So let's do a kind of quick example of the math to just show how this actually works mechanically. So let's suppose that our taxpayer is 35 years old. They're filing for this year. They have no dependents and they are not married. They also have no adjustments to income and they'll take the standard deduction. So that means that their gross income is $45,000. They have no adjustments that we said. So their AGI is also $45,000. Because they are unmarried and have no dependents, they're going to take the basic filing status of single, and then they're going to take the standard deduction. So we've determined that the standard deduction for the single filing status is $14,600, and we've determined that that is more than the itemized deductions that they can take. So $45,000 minus that standard deduction is $30,400. That's the amount that will be taxed. The first $11,600 of that is the first tax bracket. It's taxed at 10%. So that provides a tax of $1,160. The remaining money, there's $18,800 left in taxable income. That's taxed at the next rate, the next bracket of 12%. That creates a tax of $2,256. And that $1,160 number plus that 2,256 number is $3,416, meaning the total tax liability for the year is $3,416. Now, if math is not your thing, as it is for most of us, that is okay, because you will not actually have to do these calculations yourself. These days, once you determine your taxable income, the computer will apply the tax rates and spit out, your actual tax based on your taxable income. So don't worry about that. It's all automatically done these days. Okay, so we've determined that this person owes income tax based on the amount of taxable income that they had after their adjustments, after their standard deduction. But that doesn't necessarily mean that they won't get a refund. It might mean that they actually could, get still a refund, or they might owe money. They might have to send in a payment now to the IRS or to the Illinois Department of Revenue. But which case that is, whether they're going to pay money, whether they're going to get money, it depends on what we do at the next step. It depends on their withholdings for the year and also how many credits they could claim for the year. So let's look at that. The last step here. Okay, so tax credits. These are easy to confuse with deductions, which we talked about earlier. Deductions reduce the amount of income that will ultimately be taxed before the tax is calculated, whereas tax credits come into play after your tax liability, your tax has been calculated based off your taxable income. Tax credits count as dollar for dollar payments towards the tax due. So for example, if you get a $500 credit, that reduces your amount of tax directly by $500. Tax credits can be either non-refundable or refundable. So a non-refundable credit means that it can reduce your tax down to zero, but that's the end of the story. Whereas a refundable credit, it can reduce your tax down to zero. And then if you have credit left over, even after it's knocked out the tax, you can get it back as a refund, hence the term refundable credit. So a quick example, suppose that you had a $500 tax and a $1,000 credit. If it's a non-refundable credit, the credit will knock out the $500 in tax. There's $500 left over, but that's a bummer. It will not be refunded to you. That's the end of the story. But if you have a $1,000 refundable credit, $500 of that knocks out your tax. There's $500 left over. That means you will get a $500 refund check in the mail or through direct deposit from the IRS. So refundable credits, those are the best. We love those because it can actually result in more money in your pocket. So some examples of tax credits, both non-refundable and refundable. The child tax credit is non-refundable, and that's $2,000 per child dependent who qualifies. The child and dependent care credit is a non-refundable credit that is based on money that you pay for childcare throughout the year so that you as the taxpayer are able to work. And the retirement savers credit is another non-refundable credit that incentivizes low-income taxpayers to make contributions to retirement accounts throughout the year. So if you put money into a 401k or an IRA and you are below the income threshold, you might get this retirement savers credit, which is doubly good because saving for retirement is great, getting a tax credit is great, awesome. Refundable credits, on the other hand, so the additional child tax credit is a refundable credit. So this is, a child tax credit for certain taxpayers who have a certain amount of earned income or three or more children. They can receive up to $1,700 per child refunded. So the child tax credit is sometimes refundable, sometimes not. If it is refundable, it'll be called the additional child tax credit. The earned income tax credit, this is a big one to know about. This is also refundable, and this is a big way that the government supports low-income and moderate-income taxpayers who work throughout the year, who work hard throughout the year. You can receive it based on your filing status and your household size, but again, you have to have enough earned income, but not too much to get this refundable tax credit. But a lot of folks in the city do qualify, so we really encourage you to look into this and make sure that you're claiming it if you're eligible. Okay, but in addition to credits, you don't want to forget what you already paid throughout the year. These, payments that you made throughout the year are fully refundable. So if you pay too much, that's okay, because you will get it back, in April when you file your taxes. It's better for this reason, better to withhold too much than too little. We would advise. If you're an employee, you will fill out Form W-4 to have your employer withhold taxes throughout the year. So basically, each paycheck, based on the information on your W-4, instead of paying you the full paycheck, your employer will take some out. They'll send it straight to the IRS, and you'll get credit for that. And doing this throughout the year is good because you won't get a surprise bill when you file. You won't have to pay it all at the end of the year, which can be really stressful. And also it can result in a penalty because we have what's called a pay-as-you-go tax system. We have to pay as we are making the money. We cannot just leave it all to the end and then settle it, in April. And if we do try to do that, and if we do end up owing $1,000 or more because we did not withhold enough throughout the year, we might be charged a penalty. So you really do want to make sure that your employer has an accurate W-4 on file so that they know how much to withhold, so that you are doing your tax obligations correctly, but also they won't withhold too much, because then you're getting more out of each paycheck throughout the year, and that's making it easier to make ends meet. Something that's important to know, though, is if you are self-employed, so if you're an independent contractor, maybe doing gig work, running your own business, you still have to make these payments throughout the year. It's still pay as you go, but you do not have an employer who is doing that for you automatically. What that means is you are going to have to send in estimated tax payments every 3 months or every quarter throughout the year. And we'll talk about that more in just a sec, I think. Okay. So like we said, there's an important difference between being an employee and being an independent contractor. So how do you know which one you are? A lot of it will depend on what forms your employer gives you. They will give you a W-4 when you start out if you are an employee. They will give you a W-9 if you're an independent contractor when you start out. And then at the end of the year, you will get a W-2 summarizing the money you made throughout the year if you're an employee, or you will get a 1099 form if you're an independent contractor summarizing what you made. But your employer, or rather the person paying you, the entity paying you, might not always have this correct. So it's helpful to know, what the law says about whether you're an employee or an independent contractor. And the key word in determining whether you are an employee is control. You are an employee if a specific company, your employer, controls your schedule and responsibilities. So if I were an employee for a restaurant, the restaurant might say, okay, Josh, you are going to come in for the lunch shift from 10 a.m. to 3 p.m. Here is our recipe book. Here are instructions for how to cook the food. And also you're going to use our supplies. We're going to control the conditions of your employment. Whereas if I were an independent contractor, in the restaurant industry, in that case, maybe, the client would reach out to me and say, hey, Josh, we want you to cater this birthday party, but you're going to use your own supplies. We want you to provide those. You can decide what the menu is going to be. You're going to decide, how to prepare the food, when the food's going to be prepared. We trust you on that. We trust your expertise. You are, an independent business, an independent operator who we're going to outsource to. That is more of an independent contractor self-employment situation. Let's just see, is there anything else? Yeah. Okay. And like I said, W-2 form, you'll receive this if you are an employee. It's going to summarize how much you earned, how much was withheld, and any deductions you can take relating to your wages, such as, if money was set aside to pay for health insurance, money was set aside to go into your 401k plan, that'll also be reflected on your W-2 form. So just make sure to enter those accurately when you're doing your taxes. And your employer is legally required to mail you one by January 31st after the tax year ends. But if they don't mail you one, you can request an additional copy, or usually you can go online into your employee portal, and it'll also be available electronically. So there are a few different ways to get your hands on the W-2 form. Okay, so independent contractors, on the other hand, like we were saying, they are freelancers. They're doing gig work potentially. That's how we refer to it in this day and age. They create their own schedule. They accept the jobs as they desire rather than having a set schedule imposed by the employer, and they're going to fill out that W-9 form. And the key differences in the tax experience, one of which is expenses. Unlike employees, independent contractors can deduct work-related expenses from their income to lower their income, lower their taxes. For example, an Uber Eats driver might deduct the cost of a food warming bag that they need to deliver fresh food. They also might deduct mileage that they drove for deliveries. This is a big one because, a lot of the value you're providing, a lot of the work you're doing as an Uber Eats driver is driving, is covering that mileage. And that, if you're using your own vehicle, that takes a toll on your vehicle. You have to pay for gas, you have to pay for repairs, and it's just picking up wear and tear. It's picking up mileage that will, decrease its value. And so you want to get credit for that. You want that to be deducted from your taxes so you're not paying too much. And the IRS has a standard mileage rate for this. So I believe it's 70 cents per mile. So basically, if you drove 100 miles for Uber one day, that's going to be $70 in a tax deduction. There's a standard rate for that. So just keep track of how many miles you're driving for your business. Self-employment tax, like we talked about, you do pay payroll tax, as it were, to pay into Social Security and Medicare, but it's called self-employment tax if you are an independent contractor, and you have to pay that fully yourself through those estimated tax payments, whereas it's kind of out of sight, out of mind for employees because the employer not only pays half of it themselves, but automatically withholds the rest and sends that to the government. So it's all taken care of, and you don't have to do a thing. And like we said, withholding, because you don't have someone withholding for you as an independent contractor, you have to make those estimated tax payments 4 times throughout the year. So that's very different as well. Okay, this is just a little overview of what a 1099 form is. Like I said, it's paid to a non-employee who receives, I believe, more than $600 throughout the year from someone who is engaging them to do certain work. And it can look like a few different things. There's a 1099 NEC, that stands for non-employee compensation. So that's when, say, Uber pays a driver directly certain promotions or certain fees that the driver is entitled to. 1099K is electronic payments accepted by the independent contractor from customers directly. So if you're an Uber driver, most of your income is from customers paying you directly, and so that would show up on a 1099K form. 1099G is for gambling winnings, and a 1099 miscellaneous is kind of for any other thing under the sun that you got as income and need to report on your tax return. So keep an eye out for 1099s, coming to you in the mail in January, and then make sure to report those on your tax return and understand, the proper tax treatment for each of them. Okay, we are just about at the end here. And one more thing to cover is that, your federal return and your state return can be filed by paper or, for certain tax returns electronically. Most, 2024 tax returns can be e-filed electronically, as we say. And we encourage folks to file electronically if they can. There's just more reliability procedurally. There's fewer things that can go wrong when you're, comparing it to to the mail these days. And also you'll just get your refund a lot quicker. It'll be processed quicker and your direct deposit will show up quicker as well. Or your paper check will arrive in the mail quicker too, because that processing time is quicker. So you either have to sign your physical paper return if you're mailing it in, or you have to sign a consent form enabling the tax preparer that you're working with, such as LadderUp, such as H&R Block, such as whoever you're having your taxes prepared by, so that they can file it electronically for you. You have to have special authorization as a tax professional to e-file, and so we cannot generally do that ourselves, which necessitates this consent form. And something to be aware of is that even if someone is doing the return for you, you are responsible for what is on the return. When you sign the return, you are verifying that. You're also agreeing that you will pay whatever tax it says is due. And so that means it's important to work really closely with your tax preparer, ask them lots of questions, make sure they're asking questions of you so that they really understand your situation and can prepare a return that is both as advantageous as possible to you, claiming all the deductions, all the credits that you can, but is also accurate and also will not kind of come back to bite you if the IRS finds an inaccuracy and then needs to ask questions about it and send you letters about it, which no one wants. So you really want it to be a collaborative process, and you really want to make sure that that your returner, your tax preparer, is signing the return as well. Oftentimes, kind of sketchy tax preparers who maybe are going to claim credits that you're not entitled to and try to, direct the refund to themselves. They get away with this usually by not signing the return because they know that what they're doing is wrong and that, the IRS will come down on them if they do sign the return. So make sure that you're talking collaboratively with your preparer and that your preparer's name is on your return, clarifying that they worked with you and that they, are also responsible for what's on the return jointly with you. All right, that's the end of the presentation. Thank you very much. And yeah, I'd love to, answer any questions that might have popped up during the presentation, because I know that taxes can generate a lot of questions. Okay, Sean says, what do I file if I'm a college student? And that really depends. The answer with taxes very often is going to be, it depends. I know that's not very satisfying. But the first question to ask if you're a college student is, did you make any income throughout the year? Because generally, if you don't make any income, you don't need to file taxes. And specifically, the number to think about is that standard deduction, which, for most students will be that $14,600 number. Because if you made less than that, if you made, say, $10,000, the standard deduction is going to wipe out all of that. So you will not have any taxable income. You will not owe any tax. And so there's no requirement to file. That goes for whether you're a student or whether you are not a student. You want to ask, am I below that standard deduction amount? And, I will say, though, that even if you're not required to file, it still may be helpful to file because, filing every year can prevent identity theft. It makes it harder for fraudulent folks out there to file a return for you. And also you might get a refund of any withholdings that you had throughout the year that didn't need to be paid ultimately, or if you have any refundable credits, you also might get, a refund for that. So I would ask, am I below the standard deduction? And then, yes, that's a great point, Sean. There are a few deductions that college students can take advantage of. They're called education credits. Actually, there's one that's called the American Opportunity Credit, and that's partially refundable. So that's the one that if you can claim, you want to claim that one. But there's also the lifetime learning credit. And so if you take classes during the year, your college, and if you paid for classes during the year, if you had expenses for college throughout the year, your college will issue something to you called a 1098-T form, listing, exactly how much you paid them for school throughout the year. And that will be the basis for claiming those American Opportunity Credits or lifetime learning credits. So make sure that when you file your taxes, you bring that 1098-T form to prove how much you paid, and so that you can take a credit for that. Okay. It looks like there are no more questions. Going once, going twice. Okay. Well, if that is it, I've had a lot of fun presenting on this, and I'm really thankful to the Treasurer's Office for having me in. I really do enjoy, spreading the word and just, again, helping people understand taxes as best as I can within an hour. That's the thing about taxes, is that there's kind of endless complications that can come up. The tax code, the tax laws are very long. And so, today we only talked about really the basics, but even just understanding the basics can get you a long way and give you a lot more confidence in making sure that you are, handling your obligations and getting, any benefits that you are entitled to. So I hope to see some of you out at our LadderUp tax sites, before April 15th to get filed. And yeah, thank you so much and have a great rest of your day.
Chicago, it's time to build wealth. Get ready for the 5th annual Building Wealth Today for Tomorrow Financial Empowerment Summit. Returning Saturday, October 4th to the UIC Forum. Gain the tools you need for financial success with expert-led workshops on financial planning, home ownership, investing and entrepreneurship, money management, and more. Hear wealth wisdom from inspiring celebrity keynotes. Are you ready to transform your financial future? Register for free at chicagoCityTreasurer.com/BWTT. One day, one location, endless opportunities. See you October 4th at BWTT. Mark your calendar and register today.
Thank you for tuning in to Money Mondays with Melissa. We hope you enjoyed today's session and found value in the topic of discussion. Follow Chicago City Treasurer on Facebook, Twitter, Instagram, and LinkedIn to stay on top of all upcoming events. Remember, if you have any questions, feel free to reach out to the Chicago Treasurer's Office at 312-744-3356 or visit www.chicagocitytreasurer.com. We'll see you next time for Money Mondays with Melissa.